Hi, we're back for Class 6 on the Monday, Wednesday, Friday schedule, or the second part of Class 4 on the Tuesday, Thursday schedule. So this would be 4B if you're following along, if you have your notes or PowerPoint out for Tuesday, Thursday. So up to this point, we've learned that we're keeping track of the transactions for an organization. That's what we accountants are doing. And the point is to eventually put out some financial statements. Right? So at some point in time, we're going to take all the transactions we've been tracking and sort of sum them all in reports, like the income statement, the statement of retained earnings, the balance sheet, the cash flow statement. But before we can get to those reports, which is what people want to read and use, we have to actually record everything that goes on. Those are the transactions, right? So we record transactions in specific ways. In the last recording that you watched, so in Class 5 or Class 4A, we learned about debits going on the left and credits going on the right, and that depending on the kind of account, you're either increasing with a debit or decreasing with a debit, depending on which kind of account it is. But a debit's always on the left, credit's always on the right. So as we're posting transactions, we know we're keeping our equation in balance, A equals L plus E. We know that assets, whichever kind of asset it is, cash, accounts receivable, land, whatever kind of asset, it increases with a debit. So anytime you get more of an asset, you debit that, right? So if you got $100 in cash in, you would debit that because you're increasing the cash. If you paid cash out, you're decreasing the cash, so you credit that. So assets increase with debits, therefore their normal balance is a debit. We also have learned to this point that liabilities and equity decrease with debits. Right? So that means they increase with credits. So if you get an additional liability, let's say you go to the bank and take out a loan, you've increased something you owe. So you would credit that, put it on the right as a credit. So if you take out a $10,000 loan, that's increasing a liability. So you put that on the right as a credit, $10,000. We learned about the dual nature of transactions already. So we know that we have to keep our equation in balance. So there's not just one transaction. There is one transaction, but there's usually two or even more accounts being affected, and there has to be a debit and credit balance. So for example, that loan. You take out a loan for $10,000. Well, when you take out that loan, you're not just adding to the liability, right? So you're increasing your liability by crediting it $10,000, but you did get cash, so you increase that cash asset $10,000. So you've increased cash, that's a debit of $10,000. You've increased liability, so that's a credit of $10,000, and you're balanced. So keep in mind as we start learning how to record transactions, always keep thinking back to assets increase with debits, liabilities and equity increase with credits, and keep that equation in balance. If you keep these ideas in mind, I think it'll be a little easier to analyze and journalize and post transactions. All right. So first we're going to talk about recording transactions. How do you record a transaction? So as we've been playing Monopoly, maybe by this point we've played it a little bit, and maybe you've been thinking about transactions, right? Every time you pass go, you collect $200 in salary. So that's a transaction, right? We gotta think about transactions and recognize them and go, okay, what happened? How do I post that? So how do you record a transaction? Well, one thing we employ are source documents. Source documents provide the information needed by accounts to record accounting transactions. Based on these documents, the business can determine how to record a transaction. So you've seen documents, things like purchase orders and invoices. Maybe you ordered something on Amazon and there was a shipping document inside that told what you bought and how much it was. Receipts from a cash register. These are all source documents that help with accounting. All right? So source documents are sort of the origin. So you have to look at that source document, you figure out what happened. The next major step in the recording process is to formally enter the transaction information into the general journal. Essentially, the general journal is a chronological record of each of the transactions recorded in a standardized format. So you have a source document, maybe a purchase order, and as an accountant you go, oh, we purchased something, right? And you'll know, okay, what do I need to do? Okay, we paid cash out, we got some asset in, some supplies or something, right? What's my debit, what's my credit, and you write it in a journal, right? In Monopoly we just made a page and it's a journal and it has, accounts and the debit and the credit. That's a journal. It's a place where you're recording your transactions. All right, so how do you actually journalize and post transactions? And of course we're going to do some of these, but so once you get your source document, you figure out, okay, what happened? There was a sale, right? I get a sales receipt. And I go, oh, we had a sale, so we got some cash in and some inventory went out. So right, you figure out what happened from that source document. Accountants use the source documents to record transactions in the journal. A journal is a record of the transactions in date order. So you can imagine, in Monopoly our journal just kind of goes in date order. As you do a transaction, you write it down. Do a transaction, write it down. That's all a journal is. It's just a chronological listing of what happened. The journal is not a record holding all of the accounts. So data has to be transferred from the journal to the ledger through the posting process. So we call this posting to the ledger. So you can imagine try to imagine like a store and people are coming in and they're buying stuff and they're paying you cash or maybe they're using their credit card and maybe sometimes a delivery man delivers some inventory and you pay him or her. And so every time something happens you write it down. Kind of like what we're doing with Monopoly, just keeping it chronological order. That's your journal, everything that happens. But there's a lot of different accounts being affected, right? Sometimes you get some cash in, so cash is affected. Sometimes you pay some cash out, so it's affected. Sometimes some inventory comes in, sometimes some inventory goes out. Sometimes you provide a service, so there's some service revenue. Sometimes you don't get paid in cash, you get a payable, right? So there's all these different accounts being affected. So we need to keep track of stuff by account, because really what you want to know is, what's my cash balance? How many accounts receivable am I owed? You don't have to go through your journal and find, oh, there's cash, right, and add it and subtract it. That's a mess. So what we do is, through the posting process, we post to the ledger. So you can imagine sitting down and taking everything from that journal and posting it to your ledger. And in our example last video, we used T accounts to kind of represent our ledger. So you post to the ledger. And that way you can keep track of things by account. So you can just go to the ledger and go, how much cash do I have? There it is. How many receivables am I owed? There it is. So let's just actually do a transaction. And I think it'll be easier. Let's just do some transactions and you'll see what I mean. All right. So this first transaction, and it's in your book too. Transaction 1, Smart Touch Learning received cash from Cena Bright in exchange for common stock of $30,000. Cash is increased with a debit and common stock is increased with a credit. The accounting equation is balanced as both sides of the accounting equation were increased by $30,000. So we did this back in chapter 1, I think, too. Cash increased, common stock increased, equation in balance. So you have to think about this. Okay, this transaction happened, right? Sheena chipped in 30,000. The company gave her common stock worth 30,000. So there's probably some kind of a document, right? A source document like a stock certificate or something that tells us this transaction occurred. A receipt written into a book somewhere that tells us this transaction occurred. So as the accountant, you're thinking, okay, what happened? I've analyzed it. I know I need to increase the asset cash and I need to increase equity common stock. So I figure out what accounts, what's my debit, what's my credit. Once I figure it out, I journalize it. I write it in the journal. All right? So once the accounts affected by the transaction are identified, the transaction is recorded in the journal with a journal entry. The journal entry contains 4 parts: the date of the transaction, the debit account name and dollar amount, and the credit account name and dollar amount, and an explanation. So, if you're an accountant and you're tracking the transactions, first step, analyze. What accounts are being affected? Are they assets? Are they liabilities? Are they equity? Are they increasing? Are they decreasing? What's happening? So once you figured that out, then you journalize. And this is an example of a journal entry. The date on what's, remember, it's chronological, so the date, which account got debited. So debits always go first. That's just the rule. Debits first. So because cash increases with the debit, you know that was your debit. So you put cash, debit, 30,000. You know common stock increases with the credit, so that was your credit, 30,000. And we always indent the credit a little bit. It's just to make it easier to read. So debit, credit, debit, credit. We balance. Our debits equal our credits. Everything's awesome. Then you just write a little explanation below. Issued common stock. Now, after we journalize, it doesn't have to be immediately after. It can be. Sometimes we keep our journal all day and then we post to the ledger. But the order of the accounting cycle is analyze the transaction, journalize it, which is what we just did, then post to the ledger. So in this example, we're posting to the ledger using a T account as an example of our ledger. After the journal entry is recorded, the transaction can be posted to the ledger. The dollar amounts are transferred from the journal to the ledger with a debit or credit identical to the debit and credit used in the journal. This step is automated when computer systems are used to record the business transactions. So what this means is we want to be able to track everything by account, so I can just look at the cash account and see what's the balance there. I can just look at the common stock account and see what's the balance there. I don't have to go through a chronologically ordered journal and pick out anything that had to do with cash. So once we've got our stuff journalized, we post it. So this is an example using a T account to represent our ledger. We take the cash and we put it on the debit side. 30,000. We take common stock, put it on the credit side, and so now our debits equal our credits in our ledger. So now we have analyzed the transaction, journalized it, and posted it to the ledger. Let's look at another one. All right. So now we got some cash at our company, we're going to do something, we're going to purchase some land. Alright, so the next transaction, in this transaction the 2 accounts involved are land and cash. So in this case we're purchasing some land for $20,000. Alright, cash is decreased because Smart Touch Learning paid cash for the asset. Land is increased, so we debit the land account. The accounting equation is still in balance because land was increased with a debit and cash was decreased with a credit of the same amount. So in this example, paid $20,000 out. So remember, debits always go first as we journalize, so we analyze it. What happened? Paid $20,000 cash out, got some land in. Those are both assets. So they're both on the same side of the accounting equation, so obviously one has to increase and one has to decrease. Well, obviously we paid out cash, it's the decrease. We always decrease assets with credits. So we increase assets with debits, so land is the debit, cash is the credit, and of course they're always the same amount, 20,000. And so we're in balance. All right. So let's go on. So we're going to do another, we're not going to post that yet because in real life you would probably go do transactions all day long and then just go back and post everything all at once, right? So the next transaction, transaction 3, Smart Touch Learning buys $500 of office supplies on account on November 3rd. So they've purchased some office supplies. Maybe there's a source document like an invoice, right? A bill came in and or maybe a purchase order or something that tells us we bought 500 of office supplies. So we have to analyze it. What accounts are involved? How much? Are they increases or decreases? So the two accounts involved are office supplies and accounts payable. The supplies will benefit Smart Touch Learning in the future. So office supplies is an asset. And you increase assets with what? Debits. The liability, accounts payable, is increased. And you increase liabilities with credits, right? It's because they purchased those on account. So we've got supplies asset increase, so clearly that's our debit. We've got accounts payable increase, that's a liability, so that's our credit. So if you look, you'll see office supplies asset debited, listed first because it's the debit. Accounts payable, slightly indented, credit, and the description, purchased office supplies. So there we've journalized the next transaction. Another transaction. On November 8th, Smart Touch Learning collected cash of $5,500 for service revenue that the business earned by providing services for clients. So we've done some work. When you earn, that's called revenue. So what two accounts are involved? Well, we did actually collect cash, so cash came in. And anytime we provide a service or sell a good, that's a revenue. And in this case, it's service revenue. So cash and service revenue are the two. Cash is increased, right? That's easy. If somebody paid us cash, cash came in, so we've increased our cash. With a debit, because customers paid Smart Touch Learning with cash, since services were performed, service revenue is increased with the credit. So here you go. Write down the date, write down the account and the debit, indent the account and the credit. So pretty basic transactions. You think you're starting to get that. Think about what accounts are affected. Where's my debit? Where's my credit? Next, on November 10, Smart Touch Learning performed services for clients which they'll pay later. Okay, so this case, we didn't get cash in. We're getting one of those accounts receivable. So somebody owes us, Smart Touch, some money. All right, so what two accounts are involved? Well, just like before, even when we got the cash for the revenue, we got that service revenue. I mean, it's still, even though we didn't get any cash, it's still service revenue. But the asset, instead of being cash, is accounts receivable. So the two accounts involved are accounts receivable and service revenue. Smart Touch Learning provided services for a customer who has promised to pay in the future. Service revenue is increased with a credit. Accounts receivable is increased with a debit. So, in our journal, which we're keeping in chronological order, we write accounts receivable, debit, 3,000, service revenue, slightly indented, service revenue, credit, 3,000. And there we go, it's recorded. All right, here's an interesting one. Smart Touch Learning paid cash expenses, $2,000 for office rent and $1,200 for employee salary. So we got a couple of things going on. We paid out $3,200 in cash, but it actually affected two different expense accounts. So let's analyze this. The three accounts involved are rent expense, salaries expense, and cash. Rent expense and salaries expense are both increased with a debit. So remember, expenses and dividends increase with debits. Cash is decreased with a credit because cash was used to pay for these expenses. An entry with more than 2 accounts is called a compound journal entry. So this has got 3 accounts going on, right? Rent expense, salary expense, and cash. So this is a compound journal entry. This entry is a compound entry because it has 2 debits and 1 credit. So that's okay. You know, when we say debits have to equal credits, we mean in the dollar amount. All right? So even though there's 2 debits and 1 credit, you'll notice the total is equal. All right, notice the total amounts for debits equals 32, which is this 3,200, which is the same as the credit of 3,200. So our 2 debits are rent expense and salaries expense in their proper amounts, 2,000, 1,200, and the cash credit, we paid out cash, so 3,200. Next transaction to think about: on November 12, SmartTouch Learning paid $300 on the accounts payable created in transaction 3. So analyzing it, thinking about it, the 2 accounts involved are accounts payable and cash. Accounts payable is decreased with a debit because SmartTouch Learning is paying the amount due to the vendor, thereby decreasing the balance owed. Cash is decreased with a credit. So cash left us to reduce a liability. So cash decreases with a credit. Liabilities decrease with debits, right? So that's great. There's our debit and our credit. So our debit is the account payable, and our credit is cash. So here's a liability that decreased, and here's an asset that decreased. Next transaction: on November 22, SmartTouch Learning collected $2,000 in cash from a client back from transaction 5. So some cash came in, right? So let's analyze these. The 2 accounts involved are cash and accounts receivable. Cash is collected from a customer and is increased with a debit. Accounts receivable is decreased with a credit, and we note that the customer no longer owes SmartTouch Learning the $2,000 balance, right? So in this case, we had on the books already an asset accounts receivable, and when that customer gave us the cash, we decreased that accounts receivable, right? Because they don't owe us anymore. So we're decreasing the account receivable, increasing cash. So increasing cash is a debit, so it goes first, right? And decreasing accounts receivable is a credit because it's an asset. These are both assets, so they're both on the same side of the equation. Asset, asset, increase, decrease. And we're done. Balance. Transaction 9, payment of cash dividend. So on November 25, a payment of $5,000 cash was paid for dividends. So you may recall dividends, they're equity account, right? So we know cash is an asset, cash going out. If we're paying out cash, that's a credit. So that's kind of always where I start my thinking when I'm analyzing. I go, is there any cash? What's happening there? Well, if there's any cash going, it's going out in this case. So dividends and cash. Dividends are increased with a debit and decreased equity. Cash is decreased to pay the dividend to the stockholder. We've got a few more transactions here, so I'm going to stop this right now on transaction 10, and we'll come back and finish this tape up. So this will finish the first part of our class, but there's going to be one more part of this